Well, good morning, everyone, and welcome to day 2 in our week-long series of webinars entitled Tidying Up the Tax Year End and Beyond. We'll be here every day at 10 o'clock for an hour-long session looking at all the issues in the EIS and SEIS industry in the world at the moment and beyond that as well. We'll be covering quite a few different subjects. If you missed yesterday, you missed a crackerjack. We had Tej Parikh, who's Chief Economist at the EID. We had Lord Lee of Hurley. We had Zoe Chambers from Octopus and Dan Rodwell from Growth Invest, talking about the bigger picture. What's happening in the world at the moment? What's happening with the economy in the UK? What's happening with Brexit? What's happening in a post-pandemic environment? And thoughts and ideas about how EIS and SES might play a part in all of that. So if you missed it, do please check out our website. The video should be on there in the next couple of days or so, and you can pick that one up. But today is the important day. However, we have 4 more fantastic panelists who I'm sure you can see on your screens. And today's all about the ones to watch, fund managers to follow in 2021. So basically, we're going to be looking and talking to the new kids on the block. We all know probably in our industry at the moment, there are a big number of well-known, established fund managers who've been around for years and years and do a great job in the EIS and SEIS market. But what about the newer entrants? We know that this is a buoyant market. We know there's always new entrants coming into the market, which is always a good sign in any market that you have new entrants into a market. So we know in other sectors as well, so the banking industry, for example, that newer challengers can disrupt an established market. So we'll have a look at that. But what we're trying to do today really is shine a light on the newcomers and discover why they've entered a crowded market, what their background is, how they're different from the usual suspects, and why you perhaps should be considering them for your EIS and SEIS portfolios for your clients. So that's what we're going to do today. We've got an hour's worth ahead of us. Please do ask questions, use the chat function. You're all Zoom veterans by now, for God's sake, so you know how to use it. It's out down the bottom of your screen here. You'll see the Q&A, you'll see the chat. Please do fire through questions through to there. I'm sure looking at our panel, there'll be lots of interesting, controversial subjects coming up, so we'll pick through them. Talking of our panel, I've spoken for way too long, so I should introduce them, and I'll let them do that themselves. So, Sanji, do you want to go first?
Well, thanks, Mark. Hi, everyone. I'm Sanji from Newable, head up the ventures team at Newable. We are an entity of kind of 650 employees across the UK, servicing the UK SME startup market. The ventures unit really is kind of focusing on looking at investing in kind of seed, post-seed and pre-series A level of funding. We're one of the longest standing angel networks in the UK, and over the last 5-6 years, we've been running funds as well. Prior to joining Newable, I was on the other side of the fence and did my fair share or stint as an advisor for over 5 years with a national advisor, where I sat on the panel and kind of on the investment committee for tax efficient investments for the group. So having had both kind of seen both sides of the fence, I think it's quite good to be able to speak with advisors and also make the changes within our EIS offering to be able to kind of answer some of the questions or get to the bottom of some of the bits that the advisors want to see. So that's me.
Thanks very much, Sanji. Raj, you're taking us on a guided tour of the office. It's very kind of you.
Yeah, no, I'm trying to find some good lighting, but unfortunately,
you're perfect. You're perfectly lighted.
Okay, fine. I thought going to the roof terrace, actually. That would be quite impressive. But
that'd be lovely. That'd be lovely. Take us on another tour. Yeah. But yeah, do you want to introduce yourself?
Yes, welcome. So thank you so much for allowing me to join this, Mark. So my name's Raj Saxena. I'm the founder of Velocity Capital. We are obviously an EIS fund that backs what we call digital distribution businesses. So it's about tech in the whole, and mainly B2C and also B2B with scale. And beyond EIS fund, we also have what we call a user acquisition venture fund, which is non-dilutive capital for EIS investors. And then we also are about to raise an institutional fund, which is a GPLP structure, for follow-on investments and other investments within the Velocity portfolio and beyond. Thanks.
Brilliant. Thank you very much. Fred, I'll go to you next.
Hi, everyone. I'm Fred, co-founder and partner here at Hatch. Hatch is about 8 years old now. For the first 5 years, we were solely investing our own money, so as angel investors, but under the Hatch brand. And then about 3 years ago, we launched our EIS fund, And last month, we launched our SEIS fund. So now we have an evergreen EIS fund, which raises 3 times throughout the year, and an SEIS fund, which raises once a year. We're investing in early stage technology businesses at pre-seed, seed, and Series A. Mainly B2B SaaS, so about 85% of the investments we do are B2B, and then the remainder are consumer and some new tech around on-demand and gig economy.
Brilliant, thank you very much. So you've probably worked out already, but we have 3 fund managers. So let's go to our professional tango dancer, Brian Moretti.
So yes, he's right. I do a little bit of dancing, but my background is actually I'm an actuary, and I do have a fair amount of finance experience. So as a standard Hardman model of sort of people in the group, we're experienced analysts who've got a background in industry. I spent 10 years as a fund manager before doing some private equity research and then sort of joining Hardman. Hardman is an independent reviewer, so we look at funds and write reports which are free for advisors or investors to read. We also do some various other services. We've got a podcast. We were chatting earlier. I've had almost everybody on the podcast on this webinar on it, apart from Fred. We had his colleague Scott, and that's also new episodes every couple of weeks. We've got advisory services for advisors, and we also run, maybe why we've been invited here, the New Entrants Network, where we help coordinate people who come in to the new managers who come into the industry.
Brilliant, thank you very much. Nick's already sent in a question saying, who said actuaries were boring? See, there we go, Brian. Actuaries aren't always boring. There we go. So look, you've worked it out already. We have 3 fund managers, Brian here and myself are going to be questioning these fund managers about what they say and trying to keep them honest. So that's kind of our role for today. So look, first questions first. The webinar series is called Tidying Up the Tax Year End. So let's do that a little bit. Before we look forward, let's look back a little bit to 2020 and just give us your thoughts on 2020, how you thought it went in terms of fundraising, portfolio companies you were working with, new investments that you made, economy-wise. Yeah, give us kind of a broad picture of 2020. Fred, I'll go to you first.
2020 was, of course, an interesting year, and there was a lot of unknowns in the market. I think what was really exciting in our specific vertical, digital, is actually in many ways COVID accelerated progress. We saw consumers adopt technology like they never have before. ESA moved their panels and webinars to webinars instead of in person. So even Mark's adopting Zoom, and businesses adopting technology and sales cycles going from 18 months in enterprise organizations to 1 or 2 months. So actually we saw this huge kind of acceleration in digital, which was really exciting. From the investor side, last year was our biggest year to date in terms of AUM. I guess any emerging manager, of course, wants every year to be bigger than the last. And that's, our goal and what we strive to do each year. We saw a lot of money coming off of public markets, which were very volatile, and going into kind of long-term or medium to long-term EIS and other type of funds, and lots of people wanting to invest in our sector. So 2020 was really exciting. For us, it was all around portfolio confidence, so making sure the portfolio is stable, not losing any jobs, not having anyone on furlough. And we achieved all of that and added north of 150 jobs to our portfolio, which was about 17 companies at the time. So overall, if we forget about the COVID pandemic, it was a fantastic year for digital EIS investments. You're on mute.
Thank you. That's the first time I've done that in about 3 months. It's a good point about the COVID market. Are you able to kind of baseline it? Was it a much worse year than you thought, a better year than you thought, or did it kind of level out? In
terms of the impact COVID had?
Yeah.
I think it's all an unknown, right? We, haven't lived through a pandemic before. The impact it had on digital, I think, is a lot higher than I expected. I knew consumers adopt tech all the time, so I get that from the consumer perspective, but we're primarily a B2B SaaS investor. So to see large organizations suddenly drop the rule book and go from 18 months of procurement to, we need this tech now because our employees are remote, or we need to embrace the new world, was fantastic. So yeah, I think last year, was accelerated a lot bigger and better than planned.
All right, thank you very much. So Sanjeev, what's your thoughts on 2020? How things all renewable?
Yeah, it was interesting. I think March 2020 was probably the worst time to have a fund close. It just has everything dipped in the market. Talking to a lot of the advisors and obviously kind of understanding what was going on, where there was so much volatility in that drop, the initial thing the advisors were thinking were like, we need to take risk off the table. How can we be adding additional risk by going into this area? And then as things started to settle down and kind of the markets came back a bit, as Fred said, what we end up seeing is actually people coming out of the equities markets and actually coming into these types of funds, especially those who understand this end of the market, where they're looking at longer term or kind of mid to long term investments where you're not going to see as much of the volatility, but also you're able to look at how this innovation's going to change and actually change the certain industries. From a COVID standpoint, like first thing we did is that kind of batten down the hatches, looked at all of our portfolios. We've got about 50 odd companies in there, making sure that they're all fully funded to be able to get through the next 12 months at that point, where needed to kind of support them through additional funding through C-bills or anything else that we could do, we were doing so. But the interesting point was, and I think it's probably going to be quite an obvious one, but we saw a lot of even medical technology kind of really taking off. So quite a big part of ours is medical technology. What I mean by actually taking off is where they were struggling to get into certain NHS trusts, or they weren't getting the traction with clinicians. The products were actually, because the NHS were kind of looking at alternative ways to create more efficiencies, or looking at things that products that they could put into place because they couldn't take on further procedures. We saw a few of our companies kind of taking off on that side and increasing sales. So I think it has been a kind of a positive overall, because you're seeing beasts like the NHS adapt to the innovation and take on different types of, obviously it's all been done in the right way and making sure that the trials, etc., were completed, but they're taking innovation, which is really positive for us. And that kind of is reflective across the industry, I think.
Sure. Yeah, I think yourself and Fred have made the point that we all had to adapt. I think advisors and financial planners more than anyone, they obviously had to do meetings over Zooms and haven't been able to do face to face, which has been a huge change. So yes, we're all adapting and trying to move forward, and we'll see what happens with the rest of the year, I guess. Raj, how about Velocity? What's been happening with you guys? You're on mute, Raj.
I make that mistake all the time.
No, you're just following me. You're just making me look good. Thank you. It's very kind of you.
So like the other guys here, so we back digital companies, and we were fortunate to do that pre-COVID, and we sort of doubled down when the sort of pandemic hit back in March. And we saw certain companies actually going from, there was one kind of startup business, which was a meal kit business, was doing £3,000 monthly recurring revenue, and now it's currently doing £100,000. So some businesses have done extraordinarily well. And one thing that we've noticed, that there's a report from Harvard Business Review, which looks at the change that's happened during the pandemic. And what you see traditionally is a sort of bell curve approach in terms of adoption, which is where you get the sort of, the early adopters coming in. But now what we've seen with digital is, instead of a bell curve, it's more of a sharp fin approach. So when you've got a business that is super hot, and those can be businesses that are pre-Series A, that's the time that you need to back them. And that's what we've increasingly found. Clearly, some businesses aren't doing so well, but the ones that are, you really need to back them. And interestingly as well, I mean, a lot of people talk about post-COVID, what's going to happen, what the corrections will be. So again, we've done our own proprietary research, looking at the businesses that we think will be resilient. So there will be some kind of correction, post-COVID. But things like obviously standard e-commerce businesses, meal kits, gaming, online gyms, for example. If any of you guys are familiar with going to the gym, that whole sector is going to be will change dramatically. So I think that the key thing is, I think we're very fortunate being in digital. And I think, if you get the right business, hopefully that can offer, really, really excellent returns on an EIS basis. I think the last thing I just wanted to say, that the way that I would view EIS, I mean, it's a fantastic initiative that Mark, you obviously had, but ultimately as kind of advisors, think about tax breaks as an added benefit. You need to actually look at the sectors that, we're in and the other guys here are in, and think of it just as an investment without the tax relief. And what's been great for us, and hopefully sustainable for us, is that, for example, in the last month, 90% of our investment is actually non-EIS now. And so, and I think that is, you know, if you invest in the right sector and view that investment on a pure basis of capital appreciation, that's the way to look at it. And digital is a very exciting sector to be in.
Sure. And fundraising wise, like Fred made the point that you're always trying to be bigger than last year. You're obviously trying to push fundraising upwards every year. And again, you know, that's always a difficulty for a new fund in being able to do that. Have you found it difficult, hard, easy this year with fundraising?
I think we did about 50% up on the previous year just from EIS, and then beyond that, even better. So no, you know, again, I think we're fortunate being in the right sector. And again, I think one of the gentlemen mentioned earlier, you know, that there's a big shift from kind of equities and traditional kind of portfolio structures a lot towards private markets, and we're seeing that a lot with, you know, some of the bigger banks shifting that way for all the obvious reasons.
I think it's also, like now, sorry to just expand on Raj's point, I think it's also a matter of a lot of the good advisors who understand the end of the market are doing so and looking at the same way they would look at the kind of discretionary portfolios, different sectors looking at different stages of business, now starting to look at the same way of EIS investing as well across different funds, different sectors, at what stages we're investing. So I think that's kind of progressed from an advisor's perspective quite good over the last year.
Sure. No, good point. Brian, I deliberately left you and probably rudely left you till last, but because I know these guys have got their own particular view, but you see the whole sector, so you see all the funds across the market. What sort of trends have you been seeing over the last year or so?
I think, I mean, what the guys have said is kind of fairly descriptive of the sector as a whole. I mean, obviously, you know, if you think about fundraising, March, everything fell off a cliff. I think the second quarter, sort of the spring quarter last year, sort of was pretty dead as well. We saw some return over the summer. I think primarily from what I've heard, people who do the regular investments, the tax planning, and then it sort of picked up a little bit, not so much over winter, but definitely I think in the new year. I think it's this quarter has felt. I mean, it's hard to judge. It's felt a bit more normal. We haven't seen any statistics, but I think my judgment is overall investment in EIS will probably be a little bit down on last year, but probably not by a huge amount. I mean, last year was also affected, so it's probably not a fair benchmark. There's definitely been people who've done very well, and clearly some of the guys there have indicated that they did very well in fundraising. There's been one or two people who've not done as well as maybe they might like or maybe they might expected. So it doesn't, it feels like a long way of saying we kind of got to something that feels a bit normal, but it's not been an easy path to get there. I think in terms of investments, you know, again, the sector as a whole is now very biased towards digital and technology investments. So yeah, a lot of these done very well. I think the challenge at the moment is there's people who've done well because of lockdown. And when lockdown comes out, they'll probably sort of see things go back a little bit. And there's others where it's actually been a genuine transformation. And I think for a lot of investors, that's the current challenge. And then there's the businesses that, you know, people, if you're in travel, you've not had a good pandemic, and you know, and then investors have to decide what do they want, or managers have to decide what do they want to do with those businesses. Do we bet on a quick recovery? Some of these have adapted, some of these have struggled.
Sure, no, it's a good point about investor strategies. I'm going to pick up a question on that in a moment. You just mentioned statistics there, so I'll just perhaps add some colour to that, because we had some information from MyCap, so thanks very much for MyCap for bringing that to us. But so the EIS funds industry, they try to track this every year about how much people are fundraising. You know, the guys on this call and others obviously, and they said for this year, obviously ending April 2021, it's pretty much flat from the previous year. And that's just in terms of funds. Obviously, there's a whole bunch of money that's raised in single companies and elsewhere as well. But certainly in terms of funds, it was pretty much as it was the previous year. So again, we always, like Fred said earlier, we always like to see it get bigger and bigger and grow the pot in that sense. But actually, you know, considering the year we've had, it feels like a bit of a result in that sense. Question I was also going to pick up on, which you picked up there, and I think Raj did as well, was around kind of sectors. You know, we're seeing we've gone up in a post-COVID world that sectors have changed. Different sectors become hot. Some are kind of fallen away, particularly hospitality and leisure and retail. As an investment strategy funds or with investment philosophy, do you follow the hot sectors and go with it, or is a good company always a good company? I'm just trying to think whether all this stuff changes your philosophy in that sense. Sanjeev, I'll go to you.
Well, that's a great question, actually. So in our case, and it'll be very similar to the others, but for us, we in 2017-18 did a bit of a study and looked at kind of overall what is our investment thesis. And for us, it's been underpinned by the fourth industrial revolution. So this is really where we're seeing the convergence of different technologies and how those different technologies are creating different types of business models, how they're impacting things like infrastructure, efficiency, equality, obviously sustainability is within that as well. So if you look at it from a top line perspective, you have an investment thesis that kind of is where technology is going over the next 10, 15 years. And then under that, you then start to build in your investment strategy that looks at those kind of smaller micro parts so that will start affecting each individual technology sector. So from that side, we become sector agnostic, but we're focusing on key technologies that are driving and underpinned by things like the fourth industrial revolution, which are having such a huge impact on how we actually live, work, and communicate with each other, work with each other, but quite importantly, creating a lot more infrastructure, sustainability, and equality.
So the fact is that a lot of this stuff was happening anyway, but COVID's kind of accelerated it or moved it
exactly,
forward.
Yeah. This has been going on. So the World Economic Forum discussed this in 2016, and they said at that point we were at the cusp of having kind of closed off the third industrial revolution, all about kind of the communication and IT and that coming in. Now we're at a point where we're seeing the convergence of that, and it's being sped up quite a bit as well. So what we're going to see over the next 10 years is going to be a lot more rapid than what we thought we saw over the last kind of revolution of the digital world.
Sure. So I want to take an example. Perhaps I'll go to Raj on this one because he mentioned meal kits. So meal kits, for example, you can all understand we're being at home. It's easy to get a meal kit delivered. We can do all that. But now we're obviously free to go out and do restaurants again. Does meal kits now fall away? Do we kind of not invest in that sector anymore? What's your philosophy there, Raj?
So as I said, our belief is that there will be a certain correction, but ultimately, I think those businesses are here to stay. You only have to look at valuations of businesses like Gusto, HelloFresh, and the likes of those companies that I think they're quite resilient. I mean, I think from the purposes of our philosophy with respect to backing digital, if I may, I'd like to tell you a little story about my own background. So I used to be the marketing director of Red Bull, and we were quite good at doing our marketing in whether it's Formula One or Sampling Girls or whatever we did. But what we could never do was measure the effectiveness of our marketing. And that is very, very, now with the advent of Facebook and Google and the likes of that, that you can actually target your target audience, and that you can back it against the data. Now, the one thing about digital businesses is that actually, again, a stat that may astound you, 40% of all venture capital ends up in the hands of Facebook and Google. It is the biggest expense that you have if you're a digital B2C business. So if you can get that right, then you've got a better chance of succeeding. So our philosophy as a business is that we provide equity for operational cash flow, and we provide debt for marketing. And that debt is non-dilutive and it's non-recourse, which again, from an investment point of view, really maximizes the equity fulfillment. And I think that is the future of digital, particularly on a B2C basis. And I think your question, Mark, was about what businesses do you back. We will back businesses that you provide equity for, but also provide that debt user acquisition aspect. And I think that is the future. And venture debt is a massive area in VC that is only but growing hugely.
Sure. Yeah, it'd be interesting to see how that comes along. Fred, I guess you have an entrepreneur's background, a bit like Raj with marketing at Red Bull. You have an entrepreneur's background. Do you take a different view? And again, I know you do B2B and SaaS, I think, et cetera, et cetera. Do you take a different view on it?
No, I think in consumer businesses, I absolutely agree. So, in our kind of cohort of fast-growing consumer businesses, we have one that's on the on-demand delivery space for groceries, which is one of the hottest spaces throughout COVID. I absolutely agree. I think B2B SaaS is slightly different, and the sales cycles there are slightly different. For us, and back to your question a second ago, and to Sanjeev's point, we just want to invest in great businesses. I'm not interested in investing in buzzwords. If it's a great business that happens to be in on-demand delivery or augmented reality, then fantastic. But I don't think that a great investment thesis is to go and invest in the US buzzwords. So our investment thesis has always been the same. We want to back really great founders that are building really disruptive digital companies that underpin the technology that we use each day. And over time, of course, that's going to evolve because, you know, as life evolves, it's going to go from big web to mobile or to AR or to whatever it may be. But I think that's very different to just investing in buzzwords to, you know, to look cool or to have logos.
So Fred, I've got a fantastic travel business that I want you to invest into. Would you even, you're getting in obviously 100 pitch decks every day or week or month or whatever. Would you still look at that business?
We have a travel tech business in our portfolio, and we doubled down last year, and we used COVID as an opportunity because his enterprise sales cycle, he was selling into luxury resorts, primarily in the Maldives and Southeast Asia. And all of these resort directors were busy every single day dealing with guest requirements, you know, Mark's special requirements that he has each day. Whereas now the resorts were shut, we used it as an opportunity to go and land grab. So we said, give your product away for the rest of the year, go and land grab, use it as an opportunity because travel is going to come back. So I think it's the same answer. I'm not answering it directly, but I'm saying if it's a great business and the market is coming back, then there's no reason why we shouldn't look at it as an investment.
Brilliant, thank you. I just want to go kind of back a step or two and understand, you know, as relatively new guys in the SEIS market, what's the attraction of raising money through EIS and SEIS? It's not the easiest thing to do. You know, there's financial planners on the line who tell you, you know, you need a track record, you need this, that, and the other before you even bother speaking to us. You know, what's the attraction of raising in this market? Fred, I'll come back to you if that's okay.
It's a great question, and attraction's an interesting word. You know, we started as angel investors, and along the way we discovered EIS and SEIS, and we made all of our UK investments in that structure. What then happened is that as we started to build a brand under Hatch, we had high net worths and sophisticated investors start to reach out to us to ask to invest alongside us. So we see the EIS and SEIS structure as the ability to work with lots of great people, to work with hundreds of underlying investors who are all interesting people, that many of them are successful entrepreneurs or C-suite execs or exited founders that not only invest, but want to provide deal flow or want to provide support to our underlying portfolio companies. I think Raj mentioned it earlier, though. I think SEIS and EIS is a bonus. These investors should be investing and advisors should be investing for the right reasons. And I get that tax relief is part of that, of course. I'm not naive to that fact. However, I think you should, you know, always look at the underlying companies and the types of investments you're doing. I don't think EIS and SEIS is the easiest way to raise a fund. You know, I think there's other ways, but I think it's a smart way to raise money from an ever-growing pool of people under a very tax-efficient scheme, which is attractive to people, but to provide that kind of wisdom of the crowd and extended network. And we've really leveraged our investors to expand our team over the last few years, and that's working really well for us.
Sure. And Sanjeev, obviously, you said earlier you've kind of looked at it from both sides of the fence. You turned to the dark side from being a financial planner in the first place. So again, how do you start to see it, having come from that background?
Yeah, so I think from my side personally, back in kind of when I was an advisor, a book that changed my view was The Future is Small. And then having done my MBA specializing in venture, I really saw that actually this is where we're going to see growth over the next kind of 20 years or so. We're not going to see the same level of growth in property markets, in the listed equities markets. So there's, what are we going to do to be able to allow individuals to get access to that type of growth? And yes, absolutely, it's not about the tax, but actually, if that helps mitigate risk and allow some people who wouldn't normally be able to look at this type of investment, if that allows them to get exposure to the potential growth of early stage ventures, this is a brilliant opportunity. We're looked at by so many countries across the world because of the type of policy. And what the EIS policy has done is actually created a great ecosystem for us in the UK, because it's attracted companies from Europe or from other parts of the world to set up here. So we're getting that point where actually we've attracted great companies. We're now seeing an influx of investors coming in who may not have been able to or may not have looked at it because of the type of risk. So from that point, I think EIS funds have a huge part to play in the market. And for us as a group, having run, we're one of the longest standing angel networks in the UK, and kind of the natural progression was going from that, where individuals have got the time to stock pick in unlisted market, to actually giving people who haven't got the time the same type of exposure with the expertise of having an investment committee and the full investment due diligence.
Sure. So Brian, these guys have made the case for why they've entered the EIS market and why it's attracted to them. What, as an advisor, financial planner, what kind of areas concern should they be looking for? You know, when can they ignore those concerns? When can they just go ahead and say, look, yep, we like these guys, let's get them on our panel, or let's invest in them?
Well, I think this, you know, I think there's two sides to that. You know, there's the sort of asset allocation aspect, which sure. I had a good chat with Sanjeev actually about on one of our podcast episodes. Sorry to plug it again. But venture capital is actually a diversifying asset class. And coming back to Raj's point about, you know, this is an investment, not a tax break. If you've not got venture capital in your portfolio, unless you've got the ultra low risk investor, you're actually doing your clients a disservice, because you can either improve returns or reduce risk by just introducing a little bit of venture capital. So I think that's really important to get over. When it comes to sort of assessing things, there was a stat I saw recently based in the States where apparently between 40 and 70% of gains in venture capital come from new managers. Now, I don't know how much that applies here, but it suggests that ignoring new managers, you could miss out on things. I think the areas most advisors are probably aware, if you look at an EIS fund, there's a standard things you look at. I think there's three areas I would highlight for new managers that you probably need to think about a bit more, or well, one in case probably a bit less than you think. So one is the team. So very few new managers start with people who are not sensible or don't sound like good people, but sometimes teams are a bit small. I've seen one or two where it's just like one man and there's not even a dog. And it's not that person's a bad person or shouldn't be managing funds necessarily, but obviously you've got that, what happens if they fall under the bus.
Risk.
Yeah. I think the second thing I would look at is sourcing. Most people have been doing some investing, but there's a difference between running an angel invest or doing angel investing and running a fund. I need high quality sourcing and steady sourcing. Having said that, if someone's got an interesting approach to sourcing, they can maybe be bringing in things that other people aren't. So sourcing, and I think the third area that you mentioned earlier was track record. And I think the track record thing is probably overdone. If you look at exits, there's only a handful of managers in an area who have a good number of exits under the existing strategies. And I think while there's a lot of long-standing managers, some of them have changed what they've done quite dramatically over the last few years. So while there's some people with a small number of very good track records, you know, there's a lot of managers who've been around 6, 7, 8, 10 years who have barely a handful of exits and don't really have much. So I wouldn't necessarily say the lack of a track record should be a barrier to what you're doing. You perhaps need, you know, and all the time you should be emphasizing the other characteristics of the manager, who the team are, what the skills, what their experience are they doing the right thing?
Yeah, I think it's a tricky one with track record. It depends on what your definition of track record is, isn't it? And most advisors, financial planning, watching would know the phrase, you know, past performance is no guide to the future. So even if another fund manager more established has done stuff in the past, doesn't mean they're going to do it necessarily in the future. And similarly for the new guys, doesn't necessarily mean they're not going to do something spectacular in the future.
I think that's an interesting question, because there is some academic research on this which suggests that, and again, it's more US than UK based. So there is some academic research that says in venture capital, there is some persistence of performance. And the latest research I saw suggested maybe 45% of people who first quartile remain first quartile next time. So you'd expect 25% to be normal. So it's not like it's guaranteed, but there is some evidence that people who've performed well in venture capital can perform well. And that kind of makes sense if you think about efficient markets, and private markets are likely to be less efficient.
Yeah, yes, I guess that makes sense. Yeah, I guess trying to compare the kind of new guys and the more established players in the market, it's a good question to go back to the fund managers and ask them, well, how do you see yourselves as being different from kind of current incumbents?
Sorry, who was that to?
We lost you then, Mark.
Who was that to?
Questions to you, Raj.
All right. So I think, well, we basically started, as I say, to back digital companies with marketing as our kind of key USP. And so we were doing that way before COVID, during COVID, and post-COVID. And just to add to some of Brian's stats, and which we know, so EIS and SEIS is fantastic tax relief. It's brilliant. It's the best in Europe, if not the world. And Mark, a lot of credit should go to you for sustaining that. And what the stats that we find is that you know, even during pandemic, there are 500,000 companies that were launched. Now, how many of those companies do you think actually get to Series A? The answer is less than 0.5%. So out of 500,000 companies, only about 2,000 of those companies will be sustainable and going concerns when larger venture capital companies come in. Now, I'm absolutely positive that the likes of Harvest and everyone else in this room has a much better track record than that. And that's the notion of venture capital. So in our portfolio, at least a quarter of the companies are, you know, absolutely flying. Obviously, not everything goes well, but I'm certain that that is the case with the other gentlemen in this room. And I think when you're looking at EIS, given that the low success rate of you know, identifying angel investments or single company investments, it's really important to have that portfolio approach. And to back people that are doing this not for the tax relief, that are doing this for pure venture capital reasons. Then you as investors have a chance of succeeding and then utilizing the amazing tax relief that's on offer, i.e. the break-in and the non-CGT, you know, hopefully on exit. So, yeah.
So in terms of yourselves and kind of the velocity philosophy, it's quite hard to say that. How do you see yourselves as being different from some of the bigger gorillas in the room who are raising funds?
So again, I don't think there's any other fund that has been focused on digital. And again, I want to emphasize the user acquisition aspect that we have. So we provide equity, and then what we can do is supercharge that business. So for every £100 of equity, we can supercharge that by 200 to £400 of user acquisition funding. So the actual return you can get on your equity investment, which is non-dilutive to you as an investor and a founder, we think is a real point of difference. You know, and I don't know many other funds in venture capital or indeed in EIS that can offer that combination, and we call that leveraged equity. And therefore, just again to reiterate, we will only back businesses that we can give that element of equity and debt at the same time.
Sure.
Thereby giving better returns, hopefully.
Gotcha. And then Fred, that's a slightly different question. I guess if you're talking to an investor, an advisor, and they say, look, I'm looking at you guys, you're a new fund, but I'm also looking at XYZ who have been in the market for 10 years and have track record. What would you say to them to try and kind of push them to your side rather than to the other fund?
I think it's a great question. I think advisors should invest where it suits their clients ultimately. And that may be the old fund that's been there for 10, 20 years, or that may be the new emerging guys on the block. I think what I would say to all advisors is to give, you know, all of us and other emerging funds a chance. Don't just dismiss us because we're new. You know, the points that Brian raised, look at our team, look at our sourcing. I guarantee you, we all put a lot of effort in to all of those points. And primarily as well, for us, it's about working with our portfolio companies. And I think that's something that's really, really unique in the market still. I think there's a lot of older funds, not the guys on this call, but older funds that have fallen into the trap of raising and investing, raising and investing, raising and investing. And the portfolio has to be supported somehow. So you either have to grow your team, you have to have domain knowledge, or you have to leverage your investor base. So I think advisors should always make the right decisions for their client. But I think from a Hatch perspective, we're an entrepreneurial-led fund. We are aligned with our investors because we invest personally in each and every tranche. And we work with all of our portfolio companies, either directly or through our investor network. So I think we provide a compelling offering. But, you know, we're not naive to the fact that, you know, the majority of our advised investors, our advised clients, have invested in Hatch and other EIS funds. And I think that's great. And I think, to Brian's point, that should be part of someone's portfolio. You know, go and diversify, pick a couple of emerging managers and, you know, one older manager, if you like, and then, you know, have real world experience and compare us as we go and make investments.
Sure, and that's a great point about diversification as well. Perhaps one for Brian to answer. But is there a case for having a diversified portfolio that, as Fred exactly says, has a little bit the old, a little bit the new, and just mixes it up a little bit?
Absolutely. I think, you know, when you come to building a portfolio, and whether you're doing a whole pile of investments at one time or you're investing over time, there is a very good case for diversifying across managers. I think managers invest at different stages. They invest in different areas. They have different approaches. I think in EIS, you've got a challenge about some of the fund sizes are quite small in terms of number of investments. And very, very rarely will investing in one EIS fund give you a well-diversified portfolio. So you need to probably invest across 2, 3, 4, 5 to get an adequately diversified portfolio in the first place. But it's obviously a key thing to be doing. And yeah, just think about, you know, the different approaches that people are doing, and that can give you a balanced portfolio.
Sure. And then Sanjeev, again, I'm calling on your financial planning experience here, because you must have been, again, on the other side of the fence, talking to fund managers, talking to them about where you're going to put your clients' money. What sort of questions were you asking those funds? And now you're on the other side. How would you answer those questions?
Yes, I think there is an importance around track record, as we've all said in this. But it's also, the key thing is looking at the investment strategy. What is it that's going to be driving their investment decisions? Where are they actually looking to invest? And I'm going to be very flippant here, and there is a place for all of these funds in the market. But I think there's a clear trend in that a lot of the older, more established funds are financial institutions, they're investment houses. And what we're seeing, and I think it's reflective of the panelists here, we're seeing a lot more kind of change in terms of new entrants coming through from entrepreneurial backgrounds or from non-traditional investment houses. And that's really important for this end of the market. We're just about catching up with the US in terms of the kind of types of investments and how we're investing. But it's really important because we're needing to provide a lot more support at this end of the market for the businesses that we're investing in. And it's a little bit more tricky for investment houses to be able to do that. And we're not saying that they don't and they can't, but it's a little bit more tricky. So it's a matter of looking at, yes, as an advisor, we want to be getting exposure to early stage ventures. Yes, you want to get some more established investment funds into there, but also you want to look at which firms and how are those funds helping those underlying businesses, where they're investing at such a point in that journey for these startups, where it's a critical kind of 2-3 years for them to get to the point of exits. In terms of how we differ, and one of the attractions for me when I was looking at coming over to the dark side was Newable. We've got 650 employees across the UK. We've got an advisory team who look at advising businesses on anything from startup marketing strategy right through to setting up in different countries. We take people onto companies onto trade missions. We've got other financial products such as lending, private equity. We've then got kind of office spaces across the UK. So with all of that together, then you bolt on the capital. You become more than just a provider of capital and an actual value add investor. And as both the other two fund managers said, this is really important for these businesses. One of our stories, an investment we made in 2017, the CEO turned around and said, we couldn't have got to where we are if it wasn't for Newable, because we got them funding from a EIS perspective. We got them non-dilutive grant funding up to £1 million. And then we took them on trade missions into India, Russia, and other countries where they've won contracts. And now that company is set up, and that's it. Like, we've kind of got them from initial kind of first 2 years in, now to a point where they're going on to Series B, C onwards.
Sure. I guess we could do a whole another webinar about the value of a VC and the value add they bring to companies and what they do for those companies. One question I wanted to ask, trying to keep the theme with kind of how you raise money, how you go about raising money as a new fund, is around some of the bigger financial planning firms. So yeah, I guess hands up. You know, I used to be at one. We used to run a panel, and I know a lot of other big financial planning firms do run panels as well. but they're notoriously hard for you guys as smaller funds or newer entrants to the market to get onto. So what's been your experience of trying to get on those panels? What kind of messages do you get back from the panel saying that you're a no at the moment, but come back to us when you've done X, Y, and Z? How's that kind of played out with when you've spoken to those bigger financial planning firms? Brad, I'll come to you.
Yeah, it's challenging to get on the big panels. So you need to be around, and we've been around now for 5-6 years now. So I think that hopefully, getting on some of the bigger guys like the SJPs, Barclays, and all the rest of it, which is a large part of the EIS market, I think that hopefully is imminent. But clearly that's a strategy that we haven't looked for that from a fundraising perspective. So predominantly that's been, the smaller, IFA groups, like the sort of second tier, if you will, like the Tilneys, the Mattioli Woods, all those type of businesses that we've had for funding, and ultimately, again, high net worths and, as I said, non-EIS investors. Again, I repeat that this month, as I said, 90% of our funding has come from outside the UK. So, and hopefully, over time, some of the big boys hopefully will look at us. But you can't base your business model on that because you'll die.
Sure. So it's a kind of nice to have in the long run, but in the short term, you need to kind of focus your energies.
And I think that's also fair enough. I mean, I think all of the gentlemen in this room, that we're all in the same position. I think proving ourselves with really, hopefully, dynamic kind of investment strategies. And yeah, in time, if that should happen, but ultimately, again, if it doesn't, it's okay.
And is that the same for you, Fred? Because I know you're probably a little bit earlier than perhaps Velocity and Raja. Is that kind of you getting nice messages back from these bigger panels? They're saying nice things to you in that sense?
Yeah, I think you go through this kind of phase where you don't get very nice messages back, and then you're still around a couple of years later, and then you start to get kind of warm messages, and then eventually you'll get positive messages. I think the thing that, with panels is that, I think a lot of this is about who you know and relationships. I think there is still a lot of that in the market. And it's breaking through that and going, look, I know we're new, I know we're emerging, but this is what we've done before and this is what we're doing. How can we work together to not get on the panel today, but to get on the panel in the future? So I think for us, it's about engaging with as many advisors and financial planning firms as possible, and telling them about what we do, updating them, showing how we do things a bit differently, and hopefully trying to build some relationships with some of them.
And then Brian, of course, you're relating this back to the work that you do on the research side. What kind of, because I know you work with some of these financial planning firms as well, what messages or advice would you give to a new fund manager who is trying to get onto one of these big panels?
I think it's, as the guys referred to, there's a little bit of patience. I think People's Lawn Fund has said it's a 3-year view, and I think actually 3 years is probably conservative before some of these guys will really look at you. I think you've got to just keep what you're doing and be consistent about it. And I would also say communication is really key. And I think this is somewhere where some of the new managers do better, but some also struggle, is if you can be very open and transparent and be regular updates and say, and particularly if you can say, we're going to do this, and then 6 months or a year or 18 months or 2 years later, you come back and say, we said we're going to do this and we've done it. That will help, because people want consistency. They want to know that they know what they're investing into, or that their clients are going to be investing into. So the more you can do to convey that across, the better the more that will help you.
Sure. So that's kind of a pathway to getting on those big panels, obviously picking up new investors and new advisors at the same time as well, I guess, is it?
Yeah, and there's certainly, and I think there's something new entrants sometimes struggle with appreciation of, is that advisor and client servicing is as important as anything else. And that can be positive about saying, okay, we've got these updates, and then there's a downside as well, because nothing annoys an advisor more is that something goes wrong and the client hears and they know nothing about it, or I mean, we are going to get the odd failure, well, probably more than the odd failure, and this comes out of the blue and sort of like, hey, this company failed last week, and you're like, well, why didn't I know? So there's all these sort of things that managers can do to make sure that that they're supporting the sort of advisors and make, again, confidence, and just even the simple administration, making sure if you're in administration, getting your EIS3 certificates back. You know, when someone sends in a form, you acknowledge, and just make people feel that, you know, it's not just disappearing in a vacuum and then 3 months later, oh yes.
Actually, if I can see you nodding your head there, this must resonate with you as a former advisor, kind of funds coming to you, setting expectations at a level here and then dropping way below that. But I guess that's something you try and avoid now as a fund manager.
Yeah, and I think a couple of you guys mentioned it previously. It's transparency and kind of it is so key in any of this, making sure that it's not just the investment's gone in and then that's it. They don't hear until 6 months later, 12 months later as to what the portfolio is, especially in our end of the market where there is so much information asymmetry. We want to, as fund managers, try and help that and actually create more transparency around the types of businesses and what we're looking at investing in. And then also making sure that actually consistency is key. And I'm not talking about consistency of every year they raise 40 million. I'm talking consistency in terms of how are they actually sourcing. There's no peaks and troughs in, oh, actually it's just a one-off, one-hit wonder. Have they actually managed to sustainably get good deal flow coming into them? To keep their due diligence level at the pace that they need to keep it at, and then also making sure they consistently manage their exits and the ways that those businesses have kind of helped along the way. So absolutely, Brian, it's a huge point on consistency. Unfortunately, I think a lot of the bigger players in the market in terms of the bigger IFAs, they think about consistency from a fundraising perspective, not from the actual underlying part, which is where they probably need to focus a little bit more in terms of the investment side itself.
Sure. And just sticking on the fundraising point now, I mentioned earlier that we kind of leveled out in terms of how much is being raised in funds from this year to last year. I think it's about 370 million from my memory, but I'll check that. But in terms of kind of growing that pot from where it is now and make it a much bigger pot, as in trying to get more advisors to invest in this area, trying to get more of their clients to invest in this area, what can we be doing to try and encourage that, do you think, Sanjeev?
The conversations I think we're having a lot more of, and is very reflective of what we've discussed so far today, is trying to help advisors who maybe don't understand this as much to look at this in a similar way that they would look at a typical listed equities portfolio of investment. They want to make sure that they're getting diversification across different sectors, different geographical areas, different stages of investing for these businesses, and actually linking it back. So for example, if an investor has got a portfolio risk level 4 or 5, where they've got kind of 70% equities, 20 in emerging markets, etc., but key themes, they can tie it back into our end of the market. And I think that's really something that advisors, some of the good ones, are starting to have those conversations and linking it back to the overall portfolio, not just thinking of EIS as a product anymore, and actually as a part of an investment strategy.
Sure. We've got about 5-6 minutes left, so if you've got any questions, please do send them through, say Q&A or chat function. Just a couple of questions that I've got just to fill in while we wait for that. So I'm an investor, a financial planner, let's say. I haven't really looked at this market before, EIS, SEIS. But a client has come to me and said, look, I'm interested in looking at investing in a fund, for example. What advice would you give to the financial planner, apart from saying, yeah, use my fund, obviously, but what advice would you give to that financial planner? Fred, I'll go to you.
I think Sanjeev just mentioned, talk about themes. It's all well and good just picking an EIS fund, but why are you investing in a certain EIS fund? Are you interested in investing in med tech or health tech, or are you happy for a broader kind of approach? What's your risk appetite? Do you want to go into an earlier SEIS fund? Do you want to go into a more diverse EIS fund? Do you want to focus on B2B SaaS? So I think picking a fund for the right reasons is a big piece of advice I'd give. And then it comes back to all of the stuff we've kind of spoken about today. Get to know the manager, get to know the investments that the manager's made before, probe on how they work with the portfolio companies, and embrace emerging managers. That's the message we all three of us are trying to give from this webinar. Don't just default to the old guys, embrace us new guys as well.
Yeah, I guess that's my bugbear. It's all too far too easy if you don't know this market just to go to the big animals or the big one. Look, see who's raising the most money and just invest with that particular fund. When actually, there's probably a more appropriate fund for your client, as you say, if you speak to them about what they actually want to invest into. So, I think that's a really good message. Just to kind of finish things off with, let's say, we've got about 4 minutes left. Just looking ahead to the rest of the year, 2021, and kind of your expectations and hopes and fears and dreams for 2021. What are you looking for this year? Is it more fundraising? Is it more investing in companies? What would make 2021 a great year for you? Raj, I'll go to you first.
Firstly, having a beer was great, which I really loved. And I'm very, very bullish about this year. I think we've got, and I think it's really important as well to back the UK, which is something that's really good about EIS. It's about jobs, it's about growth, and it's about backing the great entrepreneurs that we have here. And I think, if you're in the right sector, actually, and with the right investment opportunities, there's enormous potential for you as investors and advisors to do really good by your clients. And just to reiterate what the other two gentlemen have said, I think if you look at kind of family offices and institutions and the big kind of GPs out there, the big kind of private equity firms, all of them are now moving into private markets, increasingly so. So about 10 years ago, that sort of portfolio allocation for alternative investments would be less than 1 to 2%. And if you look at the likes of UBS and the other kind of kind of big kind of firms, they're all advising their clients to up that portfolio allocation. So I think as a financial advisor, I think you should please consider it. It's not obviously all your clients' portfolio, but certainly you should be advising them to put something in, the venture kind of the EIS digital businesses that the three of us kind of represent.
Sure, certainly looking forward to having that beer with you at some point, Raj, as well.
Sanjeev,
how about you?
Yeah, I think we're on for an interesting year. Late last year, we were awarded a £10 million fund from the British Business Investments to co-invest alongside our EIS fund and Angel Networks. Now it's making sure, apart from kind of getting more money into this area as a whole, it's making sure we're cutting through a lot of the noise and getting the real interesting businesses that are going to create that innovation. We're seeing a huge opportunity where people who wouldn't normally have kind of adapted to innovation as quick, having adapted. Let's keep that momentum going in the right ways. And I think with the right types of kind of support for these businesses, we will see that continue, and we'll see that expedition that COVID's brought set us up really well over the next kind of few years to come.
Brilliant. Fred, how about you? How's it looking for Hatch in 2021?
Yeah, I think I echo what the other guys have said. For us, 2021, of course, has to be bigger than last year, and Q1 this year has already outperformed what we raised in total for the whole of the last 12 months last year. So that's a great start. For us this year, big focus is on providing investors more opportunities to invest in a Hatch portfolio. So last month we launched our SEIS fund. So that caters for investors that want to come in slightly earlier to a slightly wider portfolio or larger number of portfolio companies. And then later this year, we plan to launch kind of a later stage fund as well for investors that have slightly different type of risk appetite and want to double down on specific opportunities within our portfolio. So it's all about, meeting investor demand, providing our investors what they want, and of course, going out and making great investments and achieving a couple of exits from the EIS fund this year.
Brilliant. That's exciting. And slightly different question for you, Brian. Obviously, we've got 3 new or emerging funds here on the panel, and obviously there's others out there as well. Do you see them kind of closing the gap on the bigger boys and girls in the market at the moment?
I hope so. I think there's most of the people I see coming into this market as new entrants, as I said earlier, they're not bad people, they're not bad managers, they're bringing some interesting ideas a lot of the time. And I think the more people we have in this market, the better. I mean, you made the point, if there's only 370 million a year going into this, that doesn't make sense from a portfolio. If I think about the portfolio of invested assets of people, that really doesn't make sense, because that means that everybody is underinvested in venture capital, or not everybody, but most people are underinvested in venture capital. So there should be more money coming into this. And the more people there are, the better. And I think, it should be very good for new people with a bit of patience.
Sure. I think that's a salutary final message. There should be more investors in this market because it is a great market and an exciting market at the moment as well. So I think if 2021 is a real opportunity for investment. So look, we're at just clicked on to 11 o'clock, so perfect timing to try and cut this one down. Thank you very much for watching today. The recording will be available on the website in the next couple of days or so. Tomorrow at 10 o'clock, we'll be doing yet another webinar for an hour. This one's on ESG and what does it mean and why you should take notice. So please do pick us up on that one. Just leaves me to say, look, thank you for joining us today. There is free membership for ESEF. Please go on the website and sign up if you're a financial planner. Please go and do that. And all I need to say to end is to say thank you to our guests. Thank you to Fred, thank you to Raj, thank you to Sanjeev, thank you to Brian. Take care. We'll see you again tomorrow.
Thanks, Mark. Cheers.
Thanks, everybody.
Bye-bye.
Thank you very much, Mark.